Hi, this is Nate Berger.
Hi, I'm Andrew Dellenbaugh.
Hi, I'm Kyle Linder.
And I'm Samuel Terry, and today we're going to walk you through the hospitality buyout of the century between Hilton and Blackstone Private Equity. So first, we're going to take a look at the macro overview of the hospitality industry in 2007. As we can see, there started to be a slow decline around the time of this deal in the revenues from this industry. And a lot of the key economic drivers here come from travel, from domestic and foreign residents. And a lot of the key buying industries are going to come from airlines and travel agencies. And a lot of the key selling industries are going to come from food and beverage and entertainment, which are provided to the guests at Hilton. What we have here is the overall trends during the time of this transaction within 2007. As you can see that the hotel industry was actually outperforming the S&P 500 and that Hilton was underperforming comparative to its competitors. So a little bit more of an overview of Hilton. It was founded in 1919 by Conrad Hilton, and he opened the first Waco Hilton Hotel by 1927. This company then grew into the large worldwide holding company it is today, with over 14 subsidiaries and a large amount of real estate holdings. Hilton also offered a wide array of options from those clients who are more cost conscious to those who are more about the luxury and lifestyle suites. To give an overview of this transaction, Hilton Hotels agreed to sell the entire business to Blackstone on July 3rd. This was at a purchase price of $47.50 per share, which is a 40% premium to the pre-announcement date. The total transaction value was at $26.1 billion and was purchased at a multiple of 15.27. The deal was structured so that $5.6 billion was provided by Blackstone and the other $20.1 billion was provided by a syndicate of 26 loan operators.
So for the transaction overview, you've got Hilton Hotels. Hilton is one of the world's largest international hospitality holding companies. Blackstone really wanted Christopher Nassetta to be the CEO of Hilton, so they picked him up from 2007, and he's led the company to the present. And Hilton has real estate holdings all across the world. Blackstone Group is a private equity firm based in New York, founded in 1985. With Jonathan Gray as the head of real estate at Blackstone. The assets under management is $31.8 billion as of 2007. And Blackstone is just a leading investor in hospitality and lodging. The debt providers, there were 26 lenders, including banks, hedge funds, and real estate debt investors. Bear Stearns and Goldman Sachs were some of the key investors. The transaction rationale and outcome. So for Hilton Hotels, the outcome was they had expanded international presence. Hilton required funding to implement an aggressive international and domestic strategy. Another outcome was an expanded number of rooms. So Hilton required capital to increase the number of rooms offered globally. For Blackstone, they purchased at a discount to the replacement cost, as well as they had unrealized organizational value. Blackstone believed there was significant value in the fragmented nature of management at the time. For debt providers, there was repayment reliance. So Blackstone's success and reputation within the private equity space allowed buy-in from many different debt providers. As we mentioned before, there were 26 different debt providers, and the purpose of this was to limit the risk as well as the asset-heavy business of Hilton. So after 6 years and 5 months, Blackstone worked with Hilton on an exit strategy in the form of an IPO offering on December 11th, 2013, with a closing price of approximately $44 per share on December 12th, which represents a paper profit of $8.5 billion.
So this here is really one of the most exciting parts of the presentation. We have a timeline of the roller coaster ride that all the different parties went through over a period of 6 to 7 years from 2006 to 2013. So the talks of the Hilton buyout really initially began in August of 2006 when the head of real estate at Blackstone approached Hilton, but they couldn't agree on a price. By 2007, they had agreed to purchase Hilton at $47.50 a share in cash. At that time, the market and investors in general were very excited about the deal and were praising Blackstone for what seemed to be a great investment. Blackstone very quickly got to work replacing Hilton's CEO with Christopher Nassetta, who was helping Blackstone work through the details of the transaction. However, over the next few months to years, the financial market crashed in the United States and the world. This spelled trouble for Hilton and other hotels and resorts like it, and Hilton's revenue began to decline. By January of 2010, Blackstone's equity value in the investment had fallen by 70%, which was really troubling to both debtors and investors in Blackstone alike. So by February of 2010, Blackstone had approached all 26 of its debt lenders and had started a debt renegotiation process. This was finished by April, and over the few years and months after that, Blackstone continued to work with Hilton to turn around and revitalize the company. By October of 2013, they had completed their second debt refinancing with Hilton and completed an initial public offering on December 11th of 2013 at $21.50 a share. So to take a bit of a look at some of the specifics of the funding of the deal, the buyout was $26.1 billion, composed of $5.6 billion in equity from Blackstone and $20.5 billion of debt at almost 80% of the deal from a syndicate of different lenders, including investment banks, hedge funds, and real estate investors. So to look at some of the sources and uses of funds, as we noted, there's $5.6 billion of sponsor equity from Blackstone itself, followed by $11.3 billion from a senior mortgage loan and an amalgamation of other loans, notes, and capital lease obligations comprising the rest of the $20.5 billion in debt.
So we wanted to get a better idea of what the Hilton transaction looked like compared to other transactions within the hotel industry. To do this, we conducted a precedent transaction analysis, including Hilton and 9 other transactions over the past 7 years. When we compare Hilton's total transaction over EBITDA, or earnings before interest, tax, depreciation, and amortization, of 15.27 against the median, we see a 10% premium against the median of competitor multiples. However, comparing the transaction value to EBIT and revenue, we see only a 1% discount of the median of competitors. The 10% premium over EBITDA may be due to the high depreciation and amortization expenses of Hilton in 2007 from the asset-heavy organization, which is one thing Blackstone and Hilton together would look to reduce through decreasing the balance sheet by franchising more of their company-owned hotels. We also wanted to understand Hilton's stock price compared to competitors using a multiples method of average price to earnings over Hilton's EPS, as well as the acquisition price of Blackstone, using 3 of Hilton's closest competitors at the time, multiplying the average price-to-earnings ratio to Hilton's earnings per share, we get a price of $22.05, which is a 215% premium of Blackstone's transaction price. We believe the premium accounts for the significant value Blackstone saw in Hilton through currently unrealized synergies. An interesting aspect of this deal happened with the debt renegotiations. As we know, the market crash in 2000 and 2008 had a significant impact on the real estate market as well as the banks. In 2008, Bear Stearns collapsed and their $4 billion portion of debt was given to the Federal Reserve of New York. In 2009, Hilton's revenue had declined by 15% and the value of Blackstone's equity had fallen by 70%. This led to a debt restructure involving all 26 lenders, a significant feat by Blackstone. Due to the severity of the market crash, the debt was refinanced at a 54% discount. By refinancing, the restructure freed up capital that allowed Hilton to properly reinvest and expand their international operations. To finalize, we want to take a brief look at how Hilton has done since the 2013 IPO. As we see here, from the $44.15 close price on the day of the IPO to the $72.90 prices of November 8, 2017, Hilton has increased their share price by 65% with a compound annual growth rate each year of 14%, performing 8% greater than the S&P 500. We want to thank you for listening in, and we hope you enjoyed this presentation.